In futures trading, margin calls and forced liquidation are two things every trader wants to avoid. These events can lead to substantial financial losses and can happen suddenly, especially in leverage trading. Hi, welcome to our excellent YouTube channel. I'm Soh. In this video, we will discuss what margin calls and forced liquidations are, why they occur, and how you can avoid them. By the end, you will have a clear set of strategies to help you trade more confidently and minimize the risk involved. We have got some great content coming up to help you improve your trading and investing knowledge and skills every week. Be sure to hit that subscribe button and turn on the notification bell so you don't miss out on any of our informative updates. Thanks for tuning in. So let's get started. Let's start with the basics, margin and leverage. In futures trading, margins refers to the deposit you make to open and maintain a position in a futures contract. Unlike a loan, it is a commitment fund to cover potential losses, allowing you to control a larger position with just a smaller initial investment. Now, this smaller investment, known as the margin, is what you need to control a large position. While leverage lets you trade with a multiple of your own funds, therefore increasing your potential profit but also amplifying your potential losses. For example, with a 10 times leverage, you can control $50,000 worth of assets with just only $5,000 of margin. While leverage can enhance profits, it can also lead to steep losses, especially if the market moves against you. A margin call essentially is a warning from your broker. It happens when your account drops below a specific level known as the maintenance margin. If this happens, you will be asked to add more funds to bring your balance back up. Now, without these additional funds, you risk losing your positions through forced liquidations. Now, think of it as renting a hotel room with a minimum deposit. If your account balance drops below that minimum, you will need to top it up or your reservation will be at risk. Similarly, in futures trading, a margin call is your chance to add funds and maintain control over your position. If you ignore or can't meet a margin call, what happens next is that forced liquidation may follow. Now, forced liquidation means your broker automatically closes your position to cover the losses, often at the losses to you. Now, it's not a choice, but it's an automatic process to protect both your broker and the broader market from further losses. Imagine you have booked that hotel room, but you can't top up the deposit when needed. Now, the hotel will cancel your booking and charge you. In trading, forced liquidation protects the broker and also limits your losses, but it also means losing your investment in the position. Margin calls and forced liquidation are common in futures trading because of high leverage and market volatility. Even a small price movements can result in substantial profits or substantial losses. Futures markets are known for their fast, large price fluctuations, meaning a 3% price drop can lead to 30% losses in a highly leveraged position. Just for an example, if your balance falls below the required margin, you risk triggering a margin call or forced liquidation. So, how can you avoid margin calls and forced liquidation in futures trading? So here are some of the few ways you can do to avoid margin calls and forced liquidation. Number one, while leverage can increase your potential gains, it also increases your risk. Using excessive leverage by trading too many positions can lead to quick and significant losses. So beginners should start with low leverage to manage risk effectively, meaning you have got to trade small according to the amount you have put in your trading account. Now, think of leverage as a tool When you use it wisely, it can enhance your return, but if you overuse it, it can quickly lead to heavy losses. Experienced traders often use only as much leverage as necessary only. They carefully balancing potential rewards against the risk of margin call. Second thing you can do is to practice a good money management. Now, money management means setting aside only a portion of your capital for each trade and never risking more than you can afford to lose. A good rule of thumb is to allocate a small percentage of your capital to each position, spreading your risk across multiple trades rather than putting all your funds into one single trade. Practicing solid money management helps you to cushion against losses and lowers the likelihood of triggering a margin call. So a good money management also means having more than sufficient capital in your trading account to trade each unit of futures contract. A good rule of thumb is to have at least 2 times the initial margin to trade per unit of contract. Thirdly, you need to be able to maintain a cash buffer in your account. Keeping a cash buffer in your account can act as a safety net, providing you extra funds to absorb losses when the market fluctuates. Now, this helps keep your account above the maintenance margin and therefore reducing the risk of margin call. A cash buffer is especially useful in volatile markets and can give you more flexibility to absorb short-term losses. Number 4, use a stop loss order. A stop loss order can automatically close your position if the market fluctuates against you by a specified amount. By setting a stop loss, you control how much you are willing to risk before you exit the position, and therefore it can help you avoid hitting the margin call level. For example, let's say if you are entering a FKLI contract at 1,600. So you can set a stop loss at 1,580 and your position will automatically close if the price drops to 1,580, and therefore this limits your losses. Number 5, please stay calm whenever you encounter margin call situation, because it is essential for you to keep cool when trading, especially if the market moves against you. Now, oftentimes emotional reactions like panic selling or revenge trading can lead to impulsive decisions, and this can worsen your situation. Staying calm allows you to make informed decisions, which is very crucial in volatile markets. Remember, trading it's about a long-term strategy. It's not about short-term emotions. And lastly, keep learning and continuous learning. Futures trading is challenging and the markets are constantly changing. By continually educating yourself and staying updates on market trends, you can make better informed decisions, whether it's understanding the economic indicators, learning new trading strategies, or staying aware of the global events. Ongoing learning can help you trade smarter and be more effective in your trade. So to sum it up, avoiding margin calls and forced liquidations in futures trading requires a careful planning and a disciplined approach. While futures trading offers opportunity for substantial profits, it also comes with high risk. Here are the things that you can do to avoid margin calls and forced liquidation. Remember, successful trading is not just about making profits. It's about managing risk and protecting your capital. Keep learning, keep improving, and make trading decisions based on strategy rather than on emotion. And with these strategies, you are better prepared to navigate the ups and downs of futures trading. If you find this video informative and useful to you, please share this video and give us a thumbs up. If you haven't already subscribed to our YouTube channel, please consider to click on the subscribe button and the notification bell so you don't miss any future videos. Thanks for watching, and remember to trade smartly and stay safe. Until next time, this is Soh. Good luck and good trading.